with us Verena Ross, the chair of ESMA, newly appointed in the course of last year. It's an absolute pleasure to have Verena with us. Verena, of course, was at ESMA beforehand as the managing director, knows the organization extremely well. It's really nice to have you with us, Verena. And following our exchange and your intervention, we'll have a panel looking specifically at the impact of fintech on CMU, and then two of your very active members will be discussing some of the global and domestic perspectives. So it's really nice to have you with us, Verena. Thank you. Stephen has been always very loyal to us, and he came earlier in his new capacity, but really it's nice to have you. And I know you want to talk a bit about the challenges to supervisors from a conduct perspective in wholesale markets coming from the digital transformation. Thank you very much.
Thank you very much, Nick. And it's a great pleasure to be with you here at the 6th annual FinTech and Regulation Conference of Afore Consulting. And indeed, Stephen spoke before lunch. I'm now speaking after lunch, and let me get straight into it. First of all, very good afternoon to everyone who is listening. Today, I will try to reflect on how the growth in the digital technology is radically altering the financial sector, in a way mirroring the changes in the broader society. These innovations bring benefits, but they also bring risks. I will then also explore how financial regulation can adapt to ensure that investors and markets can thrive in this new environment. In short, how do we keep track in an evolving digital world? Digital technologies continue to reshape financial services and the wider economy. It's easy to forget how fast digital technology changes. If we just look back 15 years ago, for instance, it was not possible to trade stocks on your mobile phone, let alone trade crypto assets, which were still quite a few years away. Large-scale remote working, on which we have become so dependent during the last 2 years, was not an option. The major social media platforms, again, very prominent today, were just getting started. So while the overall pace of technological change is rapid, the digital world does not always evolve uniformly. Some inventions of a new technology represent a step change, and we can't imagine life without them. Others are popular for a very short period, but a bit of flash in the pan, then disappear. As regulators, the challenge is to be timely in considering the implication of new technology and trying to identify those innovations that are here to stay and that will have a real impact on markets and/or investors. Take, for example, the creation of blockchain just over a decade ago. There was a big question at the time how impactful this new technology would be. By now, we know a bit more. Several tokenized securities have been successfully issued and transacted on blockchain. Elsewhere in the value chain, market participants are experimenting with the technology to enhance post-trade processes. And more recently, we saw the growth of so-called stablecoins, designed to be used as a means of payment and a store of value. But the story is still unfolding. One of the most prominent stablecoin initiatives so far, the Facebook-led DM project, was recently put to an end. Meanwhile, other applications of the technology are emerging, including decentralized finance or DeFi. Firms develop digital technologies to cater for consumer preferences. At the same time, our preferences and expectations as consumers are shaped by the technology. As we use digital tools in more and more situations, we expect greater convenience. Like food that is delivered to our door by Uber Eats or Deliveroo, we now have financial products and services at our fingertips on our smartphone, and the menu is expanding fast. In securities markets, the pandemic has spurred the growth of online brokers, who've seen a marked increase in new accounts and in their trading activity. This activity was driven by a spike in the overall savings rate when many people were looking for ways to fill their time during the lockdowns. The convenience and user-friendly features of mobile trading platforms attract new investors. But features that gamify the investing experience may lead some investors to trade excessively or to take on too much risk. Ideas and information spread in a new way in the age of social media. A year ago, we saw the rise of meme stocks, where participants in online communities started buying shares in companies such as the US-based retailer GameStop. Their motivations included the expectation of rapid returns, but also the prospect of punishing short sellers, or as many saw it, the big bad guys of Wall Street. The concept of meme, in fact, comes from evolutionary theory. In its original sense, it refers to a cultural practice, such as language or a social norm, that is passed down the generations. In current usage, however, it means an idea spreading like wildfire on the internet. Such memes are not a reliable source of information for prospective investors, I would argue. Alongside this, we have the rise of so-called financial influencers or finfluencers on social networks. Such developments clearly bring risks to investors, a topic I will return to a bit later. In short, consumers expect greater convenience and more choice, and increasingly they receive ideas and information from social media. This is in great contrast to the pre-digital world, where gatekeepers such as news outlets and official publications, or traditional advisors and brokers in the financial sector played a greater role. If we can harness the benefits of digital technology, we may hope to see a more democratized, even more inclusive financial sector. But there are serious risks that investors will be subject to misinformation and that the lines between regulated and unregulated products become blurred. Financial firms are capitalizing on and contributing to these trends with new business models and tools. Their common currency is data. We create data every time we use our phone, we send a text, we tweet or email, we use Facebook, we watch a video, withdraw money from an ATM, use a credit card, or even just walk past a security camera. New data-centric business models are emerging in response. Traditional financial firms increasingly rely on third-party providers, third-party services, including from the technology giants. Elsewhere in the value chain, fintechs enter the market offering specialist services, such as know your customer checks or reporting tools. Digital platforms are serving as new venues for financial and non-financial products or services. Some big techs already provide payment services, and we can expect them to play an increasing role in the wider financial sector, given their competitive advantages. They have vast data sets from their customer networks, which they can analyze with advanced tools. In keeping with my theme of evolution, this is known as the DNA loop, where DNA stands for data network activities. Put simply, customer data strengthens network effects and in turn generating more consumer activity and yet more data. The entry of fintech and big tech firms, bringing with them a growing range of specialized services and database tools, increases fragmentation and complexity of the financial services value chain. Supervisors need a clear view of the roles played by these new market entrants and the dependencies between them. Equally, we need to understand their data-focused business culture and reflect on the opportunities and risks it presents for consumers and investors. As I said earlier, if we can harness the benefits of the digital technology, we may hope to see a more inclusive financial sector, but there are also serious risks, particularly for retail investors. Let me look in a bit more detail at these opportunities and risks. Digitalization is radically changing consumer preferences and the information they receive. Digitalization also radically alters the profile of the firms offering financial services to consumers. In doing so, digitalization creates new opportunities. Consumers can receive seamless, real-time, 24/7 access to financial products and services. across borders and without the need for a physical presence. They can compare a wide range of choices at the touch of a button. Some digital platforms bring together financial and non-financial products, acting as a one-stop shop for consumers. In short, digital services can bring greater convenience. They may help boost financial inclusion, at least for those consumers comfortable with the new technology. So all that is positive. Digital innovation also provides opportunities to firms. It helps them develop and distribute their products and services to a wider customer base. In reducing the need for establishment of branch networks of physical presences, it reduces barriers to entry and also shortens time to market for new products. Online services may have lower fixed costs. And depending on the situation, third-party digital infrastructure may be cheaper and less risky than developing and putting in place systems for new products in-house. The data-centric models I mentioned bring opportunities too, using data in sophisticated ways, helping firms to understand consumer demand. This knowledge facilitates the personalized financial products and services that consumers increasingly expect and demand. More broadly, technology-driven changes to market structure may create efficiencies. Business partnerships between incumbents and fintechs or big techs can streamline internal processes, enhance fraud detection, and support risk management. However, and that's a big however, the evolving digital world inevitably also brings risks. In the financial sector, we as regulators and supervisors face some major challenges. With digitalization, financial firms increasingly rely on third-party providers. Some third-party providers are not easily substitutable and may have bargaining power to impose terms and conditions. Some may provide technology and other services, including data analytics and advertising, at such a scale that they become systemically important. The new players in the financial markets are creating a new landscape in places more fragmented and complicated. Existing reporting and supervisory frameworks may contain blind spots, especially if financial firms and technology companies interact in complex ways, as illustrated by the Wirecard case, for example. Importantly, the evolving digital world also brings risk to individual consumers. New digital distribution channels offering instant trading, coupled with sometimes aggressive marketing techniques and gamified services, these are providing a very different environment to traditional investing. Consumers increasingly have easy access to complex and highly risky products, such as crypto assets, contracts for differences, or indeed even CFDs on cryptos. And this new environment may aggravate the behavioral biases that we are all subject to. Social media information overload and gamification of financial decisions may prevent consumers from making well-informed decisions, putting them at risk. Investors need to tread carefully in this environment, and we, as regulators and supervisors, need to provide them with stable ground on which to stand. As digital technology evolves, we must continually assess the effectiveness of our rules and the way we supervise and enforce. Ultimately, we need to adapt to a changing environment to protect investors and support thriving EU capital markets for the good of our economy and EU citizens. We at ESMA want to make sure that investors are empowered to make informed choices and to have access to innovations that bring them tangible benefits. That said, where we identify new risks that are not addressed within the current regulatory and supervisory framework, we, ESMA and national authorities, will need to take firm action. Let me illustrate that through a couple of examples. First of all, a couple of days ago, the ESAs published their joint response to the Commission's request for technical advice on digital finance and related issues. Our report includes 10 recommendations for actions to ensure the EU regulatory and supervisory framework remains fit for the digital age. In summary, these recommendations relate to having adequate supervisory oversight over the entire financial value chain, enhancing consumer protection in a digital context, and ensuring a level playing field between incumbent financial firms and groups combining financial and non-financial activities. I think my counterparts at EIOPA and EBA have already outlined earlier on in the conference some aspects of this work. So I will focus my remarks on just one key topic that ESMA has particularly concentrated on, and which I've already mentioned, the rise of finfluencers, so the influencers in financial services in social media. Finfluencers are individuals who leverage social media to provide their followers with information and recommendations on a variety of financial products. Their followers discuss and exchange information about many topics relating to investing. While most finfluencers are themselves retail investors, some are actually financial services professionals. Platforms such as YouTube, Instagram, and TikTok provide access to a wide audience, especially among the young. For example, on the TikTok application, the investing-related hashtag StockTok has gained popularity through the pandemic. This certainly makes a change from whatever dance videos and recipes or something that were on the app before. But data shows that StockTok hashtag has been viewed more than 1 billion times. This is just one example of a general trend, as tech-savvy retail investors turn to social media to inform their financial decision-making. They seek information from like-minded peers rather than from traditional financial advisors. Social trading and copy trading, where you can automatically copy trades executed by someone else, are growing in popularity. In a sense, these developments are democratizing the financial sphere. People are free to choose and to discuss their investments. They now have greater means than ever before to do so. But just as democratic institutions can be undermined by the spread of misinformation, unchecked rumors and bad advice can undermine investor confidence and ultimately orderly markets. It is vital that we are, as public authorities, acting in the interest of particularly retail investors and orderly and stable markets, retain our influence over financial markets. We need to ensure our collective voice as public authorities remains loud and clear despite the noise. A year ago, the GameStop episode illustrated how social media can lead to herding and increasing risk-taking among retail investors. They were not always able to identify and separate misleading and harmful information from real facts and proper advice. In this context, ESMA published a statement clarifying the applicability of market abuse rules when investment recommendations are provided on social media. The statement recalled that investment recommendations must be done in a specific and transparent way so that investors, before making a decision, can know and assess the credibility of the recommendation and how objective it is. But I know that this fast-moving phenomenon requires active monitoring. As ESMA, we are committed, together with the national supervisors and other EU authorities, to continue our focus in this area, and we will continue to adapt our communication with an aim to reach also those consumers that really seek their information from social media. Let me now move briefly to a second related topic on which ESMA is focusing, the ongoing speculation around certain crypto assets. Total market capitalization of crypto assets has increased 8-fold over the last 2 years to around 1.5 trillion euros now, which is actually around 1 trillion below its peak in November 2021. This suggests that crypto assets are gaining mainstream acceptance. According to recent research, there are about 6% of Slovakians and about 8% of Dutch people who now own crypto assets. Most of these assets are not backed by any tangible value, and their price is also highly volatile. The majority operate outside of the EU regulated space, meaning that consumers do not have rights or protections if things go wrong. Many scams and fraudulent activity have already been reported. Yet we see growing investor interest in crypto assets. Large-scale marketing campaigns in our streets and public media aim to legitimize those assets and boost confidence in them among the public. Perhaps you've seen in your home country or city adverts like the famous one which everyone talks about on the London Tube, which with slightly questionable logic says, if you are seeing Bitcoin on the underground, it's time to buy. A flurry of celebrities and so-called crypto influencers are promoting these assets, including on YouTube channels. Some have tens of thousands of followers. At the same time, even more complex products are being developed, including some leveraging on the DeFi protocols that I mentioned earlier. Some are marketed with promises that seem too good to be true and probably are, such as returns of over 10% per annum. As you may recall, the three ESAs issued a first EU-level warning on crypto assets already in February 2018 and reminded consumers of the high risks in these assets in March 2021. But we remain highly concerned about several risks to consumers here. Some are buying these assets with unrealistic expectations of price growth and without realizing the high risks involved. At the same time, we see the consumer detriment that is being caused by scams and frauds in the crypto space. The current regulatory framework is not capturing most crypto assets, and thus investors are not protected. You might say that if they want to speculate and lose money, that is their own problem. But I believe that for many of us, it can be hard to tell the difference between a regulated financial instrument and an unregulated one, particularly if they're made available side by side in a trading app on a smartphone. In addition, much of the aggressive marketing and exciting promises hide the fact that the firms that investors sign up to are not regulated, and thus investors have no protection when something goes wrong. Digitalization has made it easier to get in touch with and attract retail investors, also cross-border and often from outside the EU. This is a new world that we live in, and therefore as regulators and supervisors, we need to adjust to. We at ESMA would like to see as soon as possible the right EU regulatory framework come into being through the finalization of the legislative process around MiCA, the Markets in Crypto Assets Regulation. So far, only some national supervisors can rely on domestic regulation and a regime for crypto assets, but most cannot. This does not offer the common EU approach to the risks that we see at the moment. Until MiCA is agreed and enforced, we are working actively with the national supervisors to ensure information exchange about scams and frauds, making sure we learn from each other's experiences when it comes to authorizing and supervising new crypto asset products, and finding common ways of addressing the risks across the EU. So to conclude, digitalization is bringing profound changes across the economy, and the financial sector is clearly no exception to that. It creates new linkages and dependencies as incumbent firms partner with technology companies, and social media affects the way potential investors receive and spread information. Opportunities from digital services, including greater efficiencies and convenience, are clearly there. But as I've highlighted, there are considerable risks, especially to retail investors. At ESMA, we will continue to monitor developments, cooperate closely with other authorities at EU and national level, and take action wherever it's needed. In other words, we will aim to keep on track of the evolving digital world. Thank you very much.
Thank you very much, Verena. For a moment, we had a Kremlin come onto the communication at the end, but we threw him or her out again. So apologies for that.
No problem.
Thank you very much for a very interesting speech with a very strong focus on the retail investors' perspective of the technological developments. I know you have agreed to maybe take a question or two, and maybe I can start with that, which is, you're right, there's a challenge if the products aren't regulated, because that takes them out of your sphere of influence, and therefore MiCA and other initiatives are very important. Even though I would say the definition of what's a financial instrument in MiFID and MiFIR is quite broad, so it'd be quite interesting how you see that evolve, I think, the definition of a financial instrument. But if we assume it is a financial instrument, we have a lot of kind of potential safeguards. We've got member states' consumer protection rules. We've got execution-only services, and that's maybe the problem we face here. But otherwise, you've got things like suitability tests, appropriateness tests. You've got advice rules, rules around research. And in the worst case, I know ESMA at some stage called for reverse solicitation rules to be introduced with certain third countries. In a way, you've got a big arsenal of tools. Is it big enough? Is it quick enough to use? Or is there too much friction between European instruments and member states' competences? Where do you see the area for improvement to respond quickly to these trends? Because these trends are moving very, very fast.
Indeed, and that I think is one of the key challenges for us as regulators and supervisors. I think what really hits on the ground, and I'm sure Robert and Jean-Paul will say the same later on, is that in the day-to-day challenges for supervisors is to actually look at what are these instruments that are coming there and how do we treat them? Are they a financial instrument or are they not? And often the question is not easily answered. It's actually quite complex. Secondly is, once you determine it's a financial instrument, yes, you do have some tools, you rightly pointed them out. But again, it then depends what the consumer is doing. Are they execution only on an app with your mobile phone, basically just hitting buy without actually checking out whether the information to properly take an informed decision on whether the risks that they are taking is the risk they want to take. And the other thing that is quite challenging is the fact, as I said, that the information is often taken through channels which are presenting themselves as providing helpful advice, but in reality might not do so. And again, it is difficult for the normal investor to look through that. So I think there are a number of different challenges in terms of how we actually do the supervision on the ground. In top of that, in a digitalized world, clearly you don't necessarily have, you can try to do mystery shopping, getting into how consumers actually buy these products, but these are very resource intensive and difficult tools to use in practice.
Thank you. And how do you square the challenge that for I don't know how many years we've been talking about the lack of retail investor participation in European markets? We always compare it to the US, where there's been a much more active environment. We're constantly talking about building out our capital markets. One element of that is to really encourage retail investor participation and education around that. In a way, COVID has contributed to that because people are more active, as you say. How do we square, in a way, continuing to promote retail investor participation as a backbone to a capital markets union while dealing with these challenges that you've described? Because in a way, you've mentioned some of the positive sides of it, but at the moment, I think the fears or concerns are slightly outweighing the policy debate.
Yes and no. I genuinely see a lot of positive coming from the ability to engage in financial markets in a far easier and also in a more direct way. I think that is a benefit, and I think it really brings different and new investors into the market. And that is a good thing. The concern that I have is how do what is the experience of those investors? I think if a lot of them are disappointed and actually realize that they have been fallen subject to scam or fraud, what it will do is it will switch them probably off from ever re-engaging in the financial market for quite a few decades. And I think that is really a concern that I have, that we need to make sure that the investors that are engaged and that we promote that engagement, but in an environment where there is a certain level of understanding and education, that there is a certain level of knowledge, and that they know where they can get the information from, and that that information is fair and not misleading. And I think that's really the core principles of any investor protection legislation and regulation. But I think we need to continuously remind ourselves of that also in this case.
Maybe one last question, Verena, how do we deal with this then on a cross-border perspective, not meaning within the EU, because that is in a way ESMA's role to bring supervisors together and share best practice. But once we look outside the EU, and maybe not to one big financial center to the west of us, but to other areas or jurisdictions. How do we deal with that? Do we have to rely on the caveat emptor principle? How do we can police, so to speak, our borders in a way, but nonetheless allow customers, investors to have choice?
That is certainly because of the digital footprint being so much larger. We have that challenge that we are dealing not just with firms providing these services to consumers in the EU from within the EU, but increasingly also on a global basis. And again, that has advantages. It gives choice, it gives different variety of possibilities. But again, what we need to make sure is that we are clear that when you provide certain services and products in the EU, you need to be also on a level playing field, regulated like other firms in the EU providing those services and products. So there needs to be a level playing field. And we need to make sure that firms realize that, and that consumers and investors, before deciding to buy, have the reflex to just double check whether a firm actually is regulated, because that also will give them the protection if something goes wrong, to complain, to have an ombudsman, to have certain rights. If they deal with firms that are not regulated within the EU, that means they have no protection to fall back on. And I think that is an education of the investor and consumer on the one hand, but also making sure that we create a level playing field for the firms that are operating and offering these type of services and products to EU consumers.
I think what is very good that some competent authorities, I can't say whether it's all of your members, but now require labeling, supervised by the ex-authority. I think things like that would help already immensely. But I'm sure
we have registers which you can easily check on whether a firm is regulated in the EU, both at national and at EU level. And we just need to promote that more. We need to kind of give consumers and investors the reflex to just quickly check that before they hit the button to interact with a firm.
Yes, exactly. And that's, I think it's interesting. I know that in a year's time we will be talking a lot about the retail investor strategy, which the Commission will bring out in the second half of this year. And I believe this will be a big issue. Thanks so much, Verena, for bringing that perspective to this conference. I enjoy this conference because every speaker brings a slightly different angle to what is ultimately similar problems. Mm-hmm. And I feel it's, without quoting Stephen, but he called it Basel by the power of three, because there's so many complex pieces changing at the same time. Thank you so much indeed for being with us. As I said to every speaker, hopefully soon in person again. And
thank you very much, Nick.
Thank you so much, Verena. See you soon.
Thank you. Bye-bye.